All right, let's take a look at this little video about depreciation. And there's a question posed right at the top of the slide that says, what is it? What is depreciation? And you may think you know the answer to this, and some of you may be saying, I have no idea what it is and I don't care. But we need to address this, uh, particularly because the way that depreciation is used generally by the lay public, uh, non-accountants, that is by and large not the way that we're going to be discussing depreciation in this chapter. So, depreciation. What is depreciation? It says that depreciation is a method of cost allocation over the useful life of an asset. This is important because some assets have a future benefit that lasts longer than 1 year. So we have to break out the cost of that asset over the useful life. And this is only necessary when we have an asset that creates a benefit for our purposes of in excess of 1 year. Okay. And that's exactly what this next line says. It says depreciation is necessary because some assets provide benefits over an extended period of time. Not the same period of time, but for an extended period of time. For example, a laptop might last us 3 years in a business setting. A vehicle might last us 5 years. A building might last us 30 years. Okay. Further information, it says depreciation is a non-cash expense on the income statement called simply depreciation expense. Okay, good information. So this is basically telling us that unlike most of our other expenses, such as payroll, utilities, insurance, we're not writing a check specifically to depreciation. This is, again, cost allocation. We're either buying an asset for cash up front and then allocating that cost over time, or we're potentially buying an asset on credit and paying for it over time. Either way, we're going to allocate that cost over the useful life. So when we see depreciation expense over on the income statement, it is a non-cash expense. Depreciation impacts the net value of most property, plant, and equipment on the balance sheet, otherwise known as long-term assets. It does say most here because one aspect of property, plant, and equipment is land, and we'd never depreciate land. So any type of property, plant, and equipment other than land, depreciation will impact the net value of these assets as they lose their ability to help us generate revenues. And we use an adjustment account over on the balance sheet for that called accumulated depreciation. But we're going to talk about that more towards the end of the presentation. So we're going to be discussing depreciation of business assets using the straight line method. And specifically, we're going to be discussing the use of straight line depreciation for a delivery vehicle. Now, having said that, we need to look at some of the advantages and disadvantages of straight line depreciation, and especially when we're talking about using it for a delivery vehicle. When we look at this, under advantages, we see that straight line depreciation is easy to understand and apply. The formula is very, very straightforward, and it is a universal formula that results in the same expense to depreciation expense each year that the asset is in place for us. Okay, so it has the benefit of being very, very simple, easy to use and apply. However, it is not related to actual use of the asset. And so we're going to, you know, as we move through this chapter, we're going to see some examples of other depreciation methods, and some of these are far superior. Now, they're not as easy to apply, but they do have other advantages. We're going to be looking in a moment at a delivery truck example, and so under straight line depreciation, let's say that we drive that delivery truck 20,000 miles in year one and 16,000 miles in year two. Well, clearly, we put more wear and tear on that vehicle in year one. However, that will not, we will not recognize that because we're going to be expensing the same amount of depreciation each year. As we move on, let's just use an example that we go 25,000 miles in year one and 22,000 in year two and 18,000 in year three. Straight line depreciation ignores lost efficiency as assets tend to age. Okay, so we have some advantages, ease of use, disadvantages. It's probably the least accurate type of depreciation because it does not follow the matching principle very well. So here is a picture of our delivery truck, and we need to determine how we are going to go about depreciating or allocating the total cost of this delivery truck over the delivery truck's useful life. Okay, so step one, we have to determine the total price of the asset. Remember, it says that the purchase price alone does not represent our total cost. Our total cost is constitute all of our one-time costs associated with getting an asset ready for use in the business place. So here we have a little bit of a review. I say a review because in the previous class we looked at this exact same scenario. It says, what should we include in the delivery truck's cost? And we have some items here, 5 items here. We have the price of the truck, sales, excise taxes, those are the same thing. An annual permit, maybe because of the type of vehicle that we have. Lettering and customization, we might want to put our company logo on the truck, that sort of thing, special paint, etc. And then also we certainly want to have an insurance. We want to have insurance on the truck in case we, heaven forbid, get into some type of an accident. So let's just see here. But, you know, some of these we might want to capitalize as part of the truck's cost, and then others, well, maybe not. So, price of the truck. This is definitely going to be a part of the truck's cost. Sales taxes are also good. And the reason is because if we look at these first two examples, we're going to purchase this truck one time. We're going to pay sales tax on that purchase one time. Let's look at the next example, annual permit. Well, we have a red X by that one. Why? The reason is simple. It is an annual permit. This is a recurring cost that we are merely going to expense as incurred, and we will not add that to the truck's cost. Truck lettering and customization. This lettering and any type of customizing that we do to the truck is intended to last over the useful life of the truck, useful life for us. And then finally, a 12-month insurance policy. Well, the fact that it says 12 months there indicates to us that this is a recurring expense, and so we would not want to include that cost. That would just be a regular expense over on the income statement. So our total cost is $50,000. That's made up of the $43,800 for the price of the truck. It's made up of the $4,000 in sales taxes and the $2,200 for the lettering. The second thing that we need to do is we need to estimate, not calculate, but estimate the asset's residual/salvage value. Residual value and salvage value are the exact same thing. They are synonyms. So how do we do that? Well, we make a guess. We make our best guess. So in this case, we're going to estimate that our delivery truck can be sold for $10,000 at the end of its useful life. You say, well, if it's at the end of its useful life, how are we going to get anything for it? It is the end of its useful life for us. But for someone else to pay $10,000 for this delivery truck, it might be worth it for them. There might still be some life in this truck for someone else. So for us, we estimate that at the end of the useful life, we can still sell this vehicle, which we have $50,000 in, for $10,000, but we get to use it over the course of its useful life. It says it is essential that we understand that this $10,000 estimate is just that. It is only an estimate. When we get to the end of the useful life, we may sell it for more or less than $10,000. And there we go. We might get more than $10,000. We might get less upon the delivery truck's disposition. So disposition and sale, those are also synonyms. Step 3 is we need to determine how long we're going to use, or what is the useful life of the asset. So as we talked about before, most assets do not last forever. There is one asset that does, at least in terms of a tangible asset, and that is land. Land lasts forever. Delivery trucks, sadly, do not. When we're using straight line depreciation, we talked about this before on the slide for advantages and disadvantages. We are concerned with the passage of time, not actual use. And in this particular case, we're going to estimate the delivery truck's useful life as being 5 years. Again, this is another estimate of 5 years. So we need to calculate the asset's depreciable base. What is the depreciable base? That means how much we can depreciate. And the depreciable base equals total asset price minus the asset's residual or salvage value. So our total asset price was previously calculated as $50,000 back in step number 1. We also, in step 2, estimated that our residual value was going to be $10,000. Therefore, our assets depreciable base is $40,000, and that constitutes our $50,000 total asset price minus the $10,000 salvage value is going to give us our depreciable base of $40,000. Step 5 is we're going to calculate annual depreciation expense. And we're going to do that by dividing the asset's depreciable base that we just calculated a few seconds ago by the estimated useful life of the asset back from step 3. So our depreciable base is $40,000, and we're going to divide that by 5 years. Remember, the straight line depreciation uses the passage of time, and that's going to give us 8,000. If you take 40,000 divided by 5, you're going to get $8,000. And this is the amount that we're going to expense each year. This is that cost allocation. We have a $50,000 asset with a $40,000 depreciable base, and we have decided we're going to allocate $40,000 of this depreciable base over the course of 5 years, giving us an $8,000 expense per year. So financial statement implications. It says that even though depreciation is a non-cash expense, it still impacts both net income and net assets. How does that happen? Well, it happens whenever we journalize the entry and it flows into initially the trial balance and ultimately the financial statements. depreciation expense is over on the income statement, and we're going to debit that for $8,000. And then we're also going to have a contra account, an adjustment account called accumulated depreciation delivery truck for $8,000, and that's all over on the balance sheet. Okay. Now I do want to say one thing really quickly. This is really not the best way to do this. In reality, what we would probably do is we would take that depreciation expense on a monthly basis. So that would be about $667 per month. And so this is actually an entry that we would make every single month. This also assumes that basically it assumes that we open the business on January the 1st, so that we get the full $8,000 depreciation in that first year. So let's take a look at a couple of slides to see exactly how this plays out on those two financial statements. This is the journal entry right here that made it all possible. Now this looks like we have an income statement for Acme Glass Company. That's the name of our business. And there's a whole lot of information here. And one thing that I will tell you is you're just going to have to get used to looking at financial statements. I know that they are tough and they're difficult to do, but you can certainly get used to it. We've got all of our revenue items. Looks like we've got some cost of goods sold, and then we have our regular operating expenses here. And look what we have here, depreciation right there. $8,000 on the income statement. That depreciation goes with all of our other expenses. And at the end of the day, we have operating income of $6,750. We didn't have any other income or loss items. So our operating income in this particular case is equal to our net income. But here's the thing. If we didn't have this depreciation expense here, this figure would go up by $8,000 and we'd have $14,750 in net income. Conversely, if we expense the entire $40,000 all at once, we're going to show a huge loss in our first year, and that would be inappropriate given the fact that we're going to be using that delivery truck for the next 4 years. Over on the balance sheet, this is a partial balance sheet. We have our current assets up here. We're not really interested in those right now. We're interested in this fixed asset section or long-term asset. We're going to play pretend here that we only have property and equipment totaling $50,000. This is our delivery truck right here. This is a very, very simplified balance sheet. Remember the historical cost principle. We're going to place this delivery vehicle on the balance sheet at its historical cost, and then we're going to use this contra account, this adjustment account called accumulated depreciation, to adjust to the net value of our fixed assets. And so we have done that here. This is the other side of that journal entry that we saw. And so now we have a net book value of $42,000 for our delivery vehicle.